in deficit. And what makes it complicated is that as the Fed raises rates, it loosens the fiscal side even more because it raises their interest expense. And someone out there is receiving that money. It could be the foreign sector, it could be banks, it could be insurance companies, it could be upper middle class or wealthy people that have a lot of cash
Us in
equivalents,
money
money
markets.
markets.
Yeah,
Yeah,
yeah, exactly.
exactly. So people are receiving that money, and that has some propensity to be spent. It's not as rapidly spent as stimulus checks tend to be, but it is income to various entities that can go out and spend it. And so the way that I keep describing that is, so back in the 70s, like money creation comes from two sources, either that monetize fiscal deficits or bank lending. And the central bank, the monetary policy is mostly designed around controlling bank lending. So things that encourage them to lend more or things that encourage them to lend less. Or the other way around, people to borrow more or borrow less. And so in the 70s, most of the inflationary money creation we had, the majority of it was from bank lending. And that was in large part because the baby boomers were entering home buying years. So there's a lot of demand for credit and there was a lot of provision of credit. And so you had a lot of broad money supply growth at a time when we also had, we were running fiscal deficits. We also had oil shortages, things like that. Treasuries as collateral to get cash, like a pawn shop.
Yep.
And of course, the treasuries are nominally very safe, and so many lenders are willing to make that. That's a very kind of easy trade to make. And there are times though where there's not enough liquidity in the system, and so the Federal Reserve directly does it. So instead of other financial entities doing it for other financial entities, sometimes the Fed itself will come in and say, look, if you have treasuries or mortgage-backed securities and kind of similarly safe collateral, you can deposit it with us and we'll give you cash for a day or 2 weeks or whatever you need. And so it's basically from the Fed's perspective, it's a risk-free loan because if it's somehow defaulted on, they get the collateral. Reverse repo is the opposite, which is it's a really good problem to have, which is I have so much cash. What am I possibly going to do with all this cash? And so the Fed says, well, we have T-bills if you need them. You could park some of that cash here, and we'll give you some of our T-bills, and then it will reverse that in a little bit. And so the reason the reverse repo facility exists is the Fed did so much QE during the stimulation years, 2020, 2021. They basically just they shoved liquidity up until there was literally nowhere else for it to go. Banks actually they have the supplementary leverage ratio. And they were kind of running into these thresholds of like how much liquidity you can put into the system. It's kind of long duration bonds because money markets are not really meant for that. Money markets are meant for very short-term types of interest-bearing assets like T-bills or very short-term commercial paper. So for a while, the Treasury was issuing T-bonds, and that's coming out of bank reserves basically. That's like as the Fed's doing quantitative tightening, and as more and more T-bonds are coming to market, that can cause a liquidity issue. There's just not enough cash that is available and wants to buy these T-bonds. But the Treasury started saying, well, if we just issue extra T-bills, there's all this cash on the sidelines that would be happy to buy about $2.1 trillion worth of T-bills. So they when they had to refill their Treasury cash account, they did it mostly with T-bills. And then even after that, in the fourth quarter of last year, the market expected a certain ratio of T-bills and T-bonds that they were going to fund their deficits with, but the Treasury surprised them by erring more towards T-bills than they expected, which allowed more money to come out of reverse repo. And it's basically just feeding all that demand that exists for T-bills. And the reason there's a lot of demand for T-bills is because if you're earning 0% on your Bank of America, savings account, but you can earn like 5% in money markets, that's where a lot of the kind of the spare capital goes. If it's not needed for working capital, and it wants that kind of doing quantitative easing to basically buy some T-bills permanently. And that all happened right before COVID. That wasn't in response to COVID. That was in the quarter preceding COVID.
Yeah.
So it was just a mechanical thing. So you could have a situation where the Fed has to quietly end their balance sheet reduction and either go back to neutral. They could do facilities. The repo facility can handle some liquidity. Things like the bank term funding program is basically a generous type of repo. Or they can just go back and say, we're going to grow our balance sheet roughly in line with GDP going forward. So we're not doing like emergency rapid QE, but we're no longer tightening anymore. I think that's what you get, not necessarily like the day the reverse repo facility runs out, but as that facility runs out, you start getting more risks for a liquidity spillover, and that's what you'd probably see the Fed respond to. I do think that probably the reverse repo facility is going to decrease a little bit slower than it has been because the Treasury general account's been filled up, and so I think that it's not necessarily going to go all the way down to zero by like March, but it is one of the key numbers that I watch every 2 weeks, roughly speaking, to see what is the descent path of this, because that's kind of the timer to look at for when the Fed has some tough decisions to make. And if you look at recent news reports, the minutes, the Federal Reserve meeting, this president did this at this time, and this country did this, and it affected this other country this other way. It's like human decisions, and of course, all those things are relevant for timing. But to that quote, I mean, they largely affect a certain area for a certain period of time, whereas technology changes things forever. Like, when they invented refrigeration, that's a permanent addition to the humanity now, as long as we don't have like an entire societal collapse. Refrigeration is now a thing that exists and it spreads everywhere, and it's not going to be undone. And same thing with electrification. Same thing is with the invention of the computer and things like that. These are permanent things. And so, to the extent that over the past century or so, there've been a lot of people complaining about the current monetary system, and they've had very little traction because they've not, you can challenge things politically all you want, but the way you win decisively is to invent something that it's just obviously better and it's permanent and it just spreads everywhere. And so basically, the reason I focused on that a lot is because the invention of Bitcoin really kind of changed the power of the argument. I mean, that part that doesn't it's not likely to win. Whereas if you have like literally this person was just trying to use transactions privately or build open source software and got arrested and things like that, and the person's got a pretty pristine record, and then there's a well-capitalized lawsuit to go after government overreach. That's a defense against this. But I do think that overall there's going to be ongoing pressure against privacy, and a way to think about that is that in the 1800s there was governments couldn't even think about how they would enforce anti-privacy laws for the most part on money, on everyday transactions. It's not even an option. But then in the telecommunications era, and as banks coalesced into banks and central banks, and basically everybody's using this big centralized banking system, and everybody was working in factories and getting regular paychecks and things like that, they could just centralize, surveil that whole system. And then they built everything around it. They built the entire like income tax dynamic is based on the premise of ubiquitous surveillance to enforce that.
Yep.
And all of the anti-money laundering and anti-terrorism stuff is all built on ubiquitous surveillance.